And now let's welcome our next guest and good friend, Anthony Saccaro. Anthony is a lawyer, but please don't hold that against him because he's also founder and president of Providence Financial and Insurance Services in Woodland Hills, California. Anthony, thanks so much for being back here with us on the Income Generation.
Dave, thank you for having me.
So, the 800-pound gorilla, recession. The Fed changed course like boom, and right in July, from anticipating rate hikes to decreasing interest rates. They're concerned about recession, obviously. Are you?
Well, I am. I think everyone in the know is concerned about a recession. And, right now we have an inverted yield curve that, depending on how you look at it, has been inverted since March until now, if you look at the 3-month as compared to the 10-year on the treasuries. And really, since World War II, an inverted yield curve has predicted every single recession save one. So I think that the bond market is telling us that there's going to be another recession. Sometimes it happens within a year. Sometimes it takes a couple of years to happen. I wouldn't be surprised if it's more than a year out because we've got the election year going on now, and I think Trump's going to try and do everything he can to keep the economy keep the economy's head above water until the election. But sometime after that, I'd be more concerned.
But, the Federal Reserve, they kind of got after it this time. Usually they're too late to the game. They made a quick 180-degree change in direction. Consumer spending is still strong. Can those two things be enough together to turn it around this time, to get us so that we dip down and come out before we actually hit recession territory? Or no? Is it, by definition, always too little too late?
Well, I think there's a couple of things to keep in mind. The first thing to keep in mind is that, we are now in the longest bull market this country has ever seen for about 1 year. We've actually gone 1 year longer than the longest bull market this country has ever seen in its previous history. So we know that from an economic cyclical standpoint, that nothing goes up forever. So at some point in time, the market's got to correct. And yet,
forget about the market for a minute, though, Anthony. Here's the reality. Half the reason with people moving up the yield curve, taking more risk because all the central banks lower rates so much, that could push people into the market where the market could still stay relatively strong, even though we might start to slip in a recession. Could that not happen?
Well, no, it can happen, but I think that's more short term. When we talk about the longer term trends, I think there's a recession, whether it's 1 or 2 years down the road. In the short run, there's definitely the market could be pushed up. Right now, interest rates are low. Dividend yields on stocks are more attractive than they have been recently. So absolutely, in the short run, anything can happen. And with the trade deal in China that I think is just certain to happen, I think the stock market stays afloat for the next year. And then after that is when I would be more worried. But we don't know. We don't know that for sure.
Anthony, hold that thought for a minute. We need to take a commercial break. Stay with us. We'll be back here in a minute on the Income Generation. I'm David Scranton, and we'll be right back. Welcome back to the Income Generation. I'm David Scranton. I'm here with my good friend, Anthony Saccaro. He's a lawyer and founder and president of Providence Financial and Insurance Services in Woodland Hills, California. Anthony, sorry to interrupt. So let's pick up where we left off. It sounds like you're saying that the markets can stay strong even as our GDP starts to shrink, as we start to head toward recession, because of some of those factors that you were telling me about, correct?
Yeah, no, you're absolutely right. The market for the last decade, in my opinion, has been artificially built and inflated anyway. In 2008, one of the reasons that turned the market around was the printing of money, the quantitative easing, and that's artificial. For the last few years, one of the primary drivers of the increase in the stock market from really 2017 to now has been stock buybacks. Well, that's artificial. Companies borrowing money to buy back their own stocks. So a lot of this has been artificial anyway, and I think we have another year of this artificial reality that could keep the stock market afloat until the inevitable happens.
Okay. Well, that's interesting because it seems like now the stock market is more animal spirits than ever before. You know, you get a piece of good news, they tend to go up. Piece of bad news, they tend to go down. They move on a tweet. The bond market, though, the bond market's what's predicting the recession. But like you say, if yields go down even further, then does that make the stock market at least temporarily look more attractive? It could. I mean, it really could, couldn't it?
Oh, 100%. And I think that's part of what the issue is. I think that's part of why the market's gone up as well as it has over the last decade, because interest rates have been down to zero. I don't think they've ever reached more than, 2.25 to 2.5. And, yields look pretty good at that point. And, the height of the interest rate increase with the Federal Reserve was back in December when I think we hit 2.5, if I'm correct. And look what happened to the stock market, right? We had a 20% decrease or thereabouts in December because all of a sudden there was some true competition.
Now, you seem to think pretty positive that we'll get through this trade war, that we'll win the trade war, I believe is what I heard you say a minute ago. And I know we have the author of The Art of the Deal in the White House, but, we also have, we're negotiating against China, really, the authors of The Art of War, Sun Tzu. So it's the President Trump versus Sun Tzu. 20 seconds. Can the president win? Will he win?
I think he will win. I mean, you got the top two powers, battling each other. And ultimately, he's got a lot more leverage on China when you look at the numbers that we don't have time to go over now. But I think he does win, and I think it's better for America in the long run. But
bottom line is, your income generation members age 55 and older need to be conservatively minded at this stage, do they not?
Oh, 100%. I mean, why try to time the market? The professionals try to get out at the top 10%, and I think we're probably in the top 10% of how high this market's going to go.
Thanks so much for being back on the show. We really appreciate that. And all I could say is I'll be praying for your Dodgers come October. All right, stay with us. We'll be right back here in a moment on the Income Generation.